Welcome to Talk Tickers, your deep dive into the latest earnings calls. Today, we're unpacking Danaos Corporation's second quarter 2025 results. And it was a bit of a mixed bag this time. We saw an earnings per share miss, but then, a really solid beat on revenue. So our mission for you today is to cut through that noise, explore how Danaos is, navigating this pretty complex shipping environment, and really distill what investors can take away from their commentary. Okay, let's kick off with the immediate takeaways. The financials from Danaos' Q2, they reported a GAAP EPS that's generally accepted accounting principles of $7.12. Now, that was actually down slightly from the prior year. More notably, though, their adjusted EPS, which kind of gives us a cleaner operational view, came in at $6.36, and that missed the FactSet consensus. Analysts were looking for $6.66.
Yeah, that miss caught some attention. But like you said, it definitely wasn't all red ink. Not at all. The company delivered a strong revenue beat, came in at $262.2 million against expectations of about $247.2 million. That's a robust 6.4% increase year over year. Pretty impressive in this market, And adjusted EBITDA earnings before interest, taxes, depreciation, amortization, it held pretty steady. $176.0 million, just a tiny 0.5% decrease year over year.
Okay, so revenue strong, EBITDA stable despite the EPS miss. And for listeners focused on capital returns,
they declared a consistent quarterly dividend, $1.85 per share, sticking with that. But I think critically, their contracted revenue backlog remains incredibly impressive. It's sitting at approximately $3.6 billion.
Wow. $3.6 billion.
Yeah.
That gives them huge visibility, right? That's like locking in future earnings for years.
Exactly. It provides significant visibility, significant stability, a real cushion.
Okay, so that's a snapshot. But now let's really unpack this because, there's always more to the story than just those headline numbers. The why is where the real insight lives.
Absolutely. Let's dig into the why. Take that $1.30 adjusted EPS miss. It wasn't really, a sign of core operational trouble. It was more the consequence of a few strategic things. A big chunk, $24.7 million, was an increase in total operating costs.
Okay.
And that was largely because their fleet got bigger. They expanded. So spending to grow.
Right. Investment. Makes sense.
We also saw about a $3.6 million rise in net finance costs, and a smaller $2.7 million decrease in dividend income they get from investments.
So costs are up because they're expanding and financing that growth, but the core business is bringing in more money on the revenue side.
Precisely. That revenue beat. That was primarily driven by a $26.6 million increase from having a larger average fleet size, plus another $2.8 million from higher fleet utilization. They're basically getting more work out of their ships.
Okay.
And these gains helped offset a decrease they saw in container segment revenues. That was down to slightly lower contracted charter rates and some, non-cash GAAP accounting stuff.
Right, the accounting adjustments. Let's talk about operating costs a bit more. You mentioned they were up.
Yeah, drilling down a bit. Daily operating costs increased to $7,556 per vessel per day. That's up from about $6,961 in Q2 last year. Management actually called this increase circumstantial. They said it was due to some bulk orders placed in Q2.
Yeah.
And they expect it to normalize, come back down in the next few quarters. Okay,
so maybe a temporary spike. What about interest expense? You mentioned higher finance costs.
Right. Net finance costs rose quite a bit, $8.9 million up from $4.6 million year over year. This was mainly because their average debt increased by about $265 million over the period.
Taking on more debt for growth, presumably.
Exactly. But it was partially mitigated because they managed to get a slightly better rate, a 90 basis point reduction in their cost of debt service.
Okay, so it's that classic balancing act in shipping, isn't it? Investing in growth, managing the associated costs and debt. Beyond the numbers, what was management's strategic storyline? What were they really emphasizing?
Yeah, that's crucial. What really stood out was their repeated emphasis on a disciplined approach to capital allocation. They were very clear that they're deliberately avoiding what they called speculative ordering, especially in the feeder segment.
Okay, explain feeder segment quickly for us and why being speculative there is a concern right now.
Sure. Feeder ships are the smaller vessels. They shuttle containers between the big hub ports and smaller regional ones, kind of feeding cargo to the giant ocean liners. Management feels the pricing for new feeder ships right now looks, disconnected from long-term fundamentals. Inflated, maybe?
Okay. So they think the prices are too high for a good long-term return. They're not chasing orders just because they can.
Exactly that. Discipline. But that caution doesn't mean they aren't growing strategically.
Right, because that backlog is still growing.
Absolutely. They added about $113 million to the contracted revenue backlog just since the last update. That brings the total to that huge $3.6 billion number with a 3.8-year average charter duration locked in. Contract coverage is super strong, 99% for 2025, and already 88% for 2026, even including the new ships coming online. That backlog is a massive buffer against, whatever the spot market does day to day.
And speaking of new ships, you mentioned new builds. There was a highlight about adding one 6,000 TEU new build, right? Slated for 2027.
Yes, and the interesting part, it was immediately fixed on a 5-year charter with a long-standing client.
Before it's even built.
Right. And management specifically pointed out this was secured because of their relationship with the yard, the shipyard, not because it was tied to some pre-existing charter requirement.
That's a neat trick. It suggests they have clout, maybe preferred access to get ships built and chartered quickly.
It definitely signals a competitive advantage. They can leverage those relationships to get new capacity built and, crucially, monetized almost immediately. Not everyone can do that.
That is a powerful position. Okay, shifting gears slightly. Capital returns. They've been buying back shares.
They have. Repurchased about 2.94 million shares for roughly $206 million so far. There's still $94.3 million left on the authorization.
But they indicated a pause. Why stop now if they have authorization left?
Well, their reasoning was the stock price has appreciated significantly. They talked about avoiding chasing the market upwards. Management even used the term market froth, suggesting they feel the stock might have run up a bit too fast, maybe too high for buybacks to be the best use of capital right now for long-term value.
Interesting. Like a savvy shopper waiting for a sale instead of paying peak prices. Discipline again.
Exactly. And that discipline is underpinned by their balance sheet, which they described as being in an enviable position. Minimal leverage.
What does enviable look like in numbers?
It looks incredibly strong. Net debt is just $224 million. That gives them a tiny net debt to adjusted EBITDA ratio of only 0.3 times.
Wow, very low leverage.
Extremely low. And get this, 53 out of their 84 vessels are totally unencumbered and debt-free. They own them outright.
That's remarkable.
It is. Plus, they have $546 million in cash and total liquidity of $924 million. That's a lot of, dry powder. Gives them huge flexibility.
Okay, connecting this back to the bigger picture, what did management say about the market and the macro outlook?
They provided some useful context there. They noted increasing clarity on global trade tariffs. Seems many are being finalized at much lower rates than feared.
Oh, that's positive. Less uncertainty.
Yeah, should ease some nerves in the sector. They also see the U.S. consumer as remaining stable, still buying foreign goods. So they anticipate a gradual improvement in trade flows as, inventories get back to normal levels.
What about geopolitical risks? Still a concern.
They're monitoring them, of course, Ukraine, Gaza, the Red Sea situation. But they reported no new disruptions to shipping routes in the last quarter. So stable for now, which is good news.
We heard their caution on feeders. Any comments on the dry bulk sector?
Yeah, still cautious there, too. They cited deflationary conditions in China impacting demand for raw materials and also elevated asset values for modern dry bulk ships. Basically, demand looks soft and ship prices look too high for them right now.
Consistent caution across speculative areas, then.
Very consistent. And maybe the flip side of that caution is their focus on innovation. All the new ships they have on order are really future-focused. Tier 3 Phase III specs, methanol-ready, equipped with alternative marine power designs, AMP.
So prepping for stricter environmental rules and changing fuel needs?
Exactly. It's not just ticking an ESG box. It's a strategic bet. They're positioning themselves to meet charterers' evolving ESG demands, potentially commanding a premium for these greener, more flexible ships down the line, turning compliance into a competitive edge.
Okay, so we've gone deep into Danaos' quarter. Let's pull back a bit. What does this all mean for you, the investor, looking at the broader shipping sector? How does Danaos fit in?
Well, what's fascinating is how Danaos' disciplined strategy really contrasts with some of the broader market pressures right now. We saw sector freight rates ease off a bit heading into August and September. Concerns about oversupply, normalizing spot rates. The Drury WCI index dipped, for instance.
Right.
But Danaos, with that huge $3.6 billion backlog in long-term charters, They're substantially insulated from that immediate spot market noise. It's like having fixed price contracts when others are riding the roller coaster.
And the market reaction seemed to reflect that, didn't it? Despite the EPS miss, the stock actually ticked up.
It did. A modest gain, 0.5% on call day, another 2.4% the next. It implies investors weighted that revenue beat, the strong backlog, and management's whole prudent approach more heavily than the earnings miss itself.
They liked the strategy over the single data point.
Seems like it. But, the reaction wasn't explosive either, which suggests the market, while appreciating Danaos' position, is still watching overall cycle normalization and cost inflation across the sector very closely. It's worth pointing out, though, Danaos has actually outperformed broader shipping ETFs like SEA and BOAT over the last 3, 6, and 12 months. Their specific strategy seems to be showing resilience.
Interesting. Looking ahead, what are the potential catalysts or things to watch for Danaos?
Well, definitely the delivery and charter start dates for those new builds we talked about.
Yeah.
Any additional charter extensions they manage to lock in would be positive, and maybe a sector inflection point. If spot rates stabilize or improve as peak season winds down and some oversupply gets absorbed, plus the macro stuff, keep an eye on tariff outcomes, those big freight indices like the WCI or SCFI. They'll set the broader scene.
Okay, great context. Now, as we wrap up, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, just for fun, like you might hear batted around a hedge fund. What have you got for us today based on Danaos?
All right, here's a thought, playing on their strategy. A green fleet quality compounder pair trade.
Ooh, okay, I like the sound of that. Lay it on us.
So the long side is Danaos. You're betting on that fortress balance sheet, the massive long-term backlog, and critically, that strategically methanol-ready Tier 3 fleet. The thesis is they're a quality player, set to benefit as ESG rules tighten, maybe even capture a green premium on charter rates in the years ahead.
Right, betting on quality and future-proofing. What's the short leg?
For the short, you find a contrast. A highly leveraged shipping company, maybe one with an older, less green fleet, someone with lots of ships coming off charter soon, right into potentially weaker spot market, and maybe no clear path or capital to modernize their ships.
Oh, I see. So you're shorting the potential loser in that green transition.
Exactly. The outrageous part is betting explicitly on that performance gap, widening between the future-proofed assets like Danaos' and those facing obsolescence. Even within the same cyclical sector, it's a pure bet on strategic foresight, winning out over short-term market noise.
A bold play on the green divide in shipping. I like it. Very thought-provoking. And that brings us to the end of our deep dive into Danaos Corporation's Q2 2025 earnings call. We saw that EPS miss, yeah, but it was really overshadowed by a strong revenue beat, all underpinned by that massive $3.6 billion backlog and management's very disciplined approach.
Yeah, their cautious stance, especially on speculative orders in feeders, and that proactive investment in greener, future-ready ships. It really paints a picture of a long-term strategic vision. They're playing the long game.
Absolutely. Now remember, everyone, the information we've discussed today is purely for educational and informational purposes. It should definitely not be considered financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.
And we definitely encourage you to check out Danaos Corporation's own investor presentation and filings on their website. Get the full details, form your own view.
Thank you so much for joining us on Talk Tickers. We look forward to bringing you more earnings insights very soon.